Hi, I'm George Coyle, the founder of Triangulated Capital Management, and I'm here today to tell you about an aggressive stock strategy that I am offering. So I put together a presentation and I'm going to share it. You can still see me down here. So I call this the aggressive growth strategy. We'll start by talking about the strategy's goals. So the goal is to produce average annual returns of 15% or higher, and at the same time to keep the drawdowns in the 25 to 30% range. I need to note that there are no guarantees with this strategy, but that's true of everything in the investment business. So let's talk about the portfolio dynamics. First, the strategy is long only. It does not go short. Second, the portfolio has a maximum of 5 single stocks. There are no ETFs or indexes at all. Third, each stock will have a weight somewhere between 0%, which would be full cash in a money fund, or 20% invested. Thus, the entire portfolio can be full cash in a money fund, or it could be 100% invested, but there is no leverage with the strategy. Finally, the strategy reviews the stocks in the portfolio once per quarter. In terms of stock selection, research indicates that groups produce better results than individuals. So these stocks are selected by combining where corporations are investing in terms of thematic secular trends, where they're putting their money, and looking at where hedge funds are investing in terms of which stocks a large amount of hedge funds are putting their money in. So when you combine those two things, that becomes the basis for the stocks in the portfolio. As you probably guessed, this is a very anti-diversification strategy, which may sound a little bit strange considering the norm. But if you study a lot of the greatest investors and traders of all time, those guys who have produced the best results, you find that they are often anti-diversification. In fact, Warren Buffett once called diversification protection against ignorance. So in line with the goal of producing bigger returns, the strategy is not diversified. And that leads to a question: what about concentration risk? Well, the strategy is governed by quantitative systematic risk management models that are designed using trader principles, and these govern the dynamic portfolio allocations. So whether the stock is full cash, fully invested, or somewhere in between. In terms of the underlying philosophy, I've done research on the last century's greatest traders, and I've identified certain common principles among them, including that you should respect price action and price trends, hold your winners and cut your losses. I wrote a small book on this, which you can find the link to here. But the fruits of my research are the basis for the quantitative models. You may look up my name and find that I am the co-author of the forthcoming Market Wizards book alongside Jack Schwager. The fruits of that research and meeting traders for that book and elsewhere is also incorporated into the strategy. So in terms of additional benefits, this is a truly unique strategy. I'm unaware of anything like it out there. If you sign up and invest, you also get my weekly publication, which shares thematic research, a review of what's happening in the markets, and both of these can provide unique and differentiated talking points for you to share with your clients. So if you're interested, I'd ask you to either watch the more in-depth video that I created. You can find the link here. I'll put it below, or you're welcome to reach out and we can have a discussion. Here is my contact information, and I hope you enjoyed the presentation, and I look forward to speaking with you. Thank you.